Ray, how you doing today?
Good, Kirk. I'm doing great. I'm happy to be here.
We're happy to have you as always. I think the last time we did this might have been about a year ago, and we were talking about
Probably is.
pricing.
Yeah, because we both had published our recent usage-based pricing benchmarks. And then this year, we've just recently released our SaaS financial performance metrics benchmarks.
That's right. Well, today it's a little bit different. Investor versus operator metric. We've got a lot of content to get through. So I think we just jump right into it. Now, everyone knows that you're a man that needs no introduction, but I'm going to do one nevertheless. Ray Rike, you all know, founder and CEO of BenchmarkIt, who helps B2B SaaS companies make metric-informed decisions with research, SaaS industry benchmarks, and media, such as your podcasts, your events, which we love. He's well known in the B2B SaaS space, podcast host, and a top executive with decades of experience leading teams from Fortune 500 companies to high growth startups. Ray, we are so excited to have you. Thanks for joining us.
Happy to be here. As a lot of people will say, it's like this guy just loves talking about SaaS metrics and benchmarks. So this is perfect.
Phenomenal. Guys, everybody who's joined today, thanks so much for joining. We're looking forward to showing you a lot of content here. You'll see there's a chat feature. Please feel free to post your questions there. We'd also love to hear where you're dialing in from. Right, we host a lot of these, and so your feedback will be very important towards the end as well. Today, what we plan on going over is summarizing these first three bullets. We're going to understand the pillars of SaaS enterprise value, right? You all probably know this from a DCF piece, but what are other ways of looking at this? Secondly, insights into the benchmarks for key investor/operator metrics, because those can be different. And then how can we make benchmarks actionable, turning these KPIs into something that's real world? Now, of course, after all of this, we're always here at Drivetrain for a consultation on how this works for your company. So definitely reach out for us. More on that a little bit later. Let's get started quickly here with a poll. What is your biggest challenge when it comes to tracking and reporting metrics? Take a look at those. If one of those isn't the answer, maybe choose the one that's most accurate to your specific use case. Secondly, you'll be hit with one. How are you currently building and tracking metrics for reporting? Okay. So let's jump into this then, Ray, as people answer their questions. SaaS pillars of enterprise values. For the next 30, 40 minutes, I just want to hear from you exclusively, and I think everybody else does. Can we jump into this in a little bit more detail?
Happy to. And by the way, the people that I want to hear from is the audience, because your questions will make this much more applicable and you can do takeaways to take it back to your company. So please do put your questions there in the Q&A. So why don't we go ahead and show the first one. So what I did about 4 years ago when I first founded BenchmarkIt and its predecessor company, RevOps Squared, I really looked at how can we think about all these SaaS metrics and how do they impact the SaaS company's enterprise value. And I broke it down into these 5 pillars of enterprise value that private investors and public investors use. So the first one is capital efficiency. For every dollar that goes into your company and you allocate to R&D, sales and marketing, right? What type of enterprise value returns am I going to get? So that's capital efficiency. But then we go into some of our operational efficiency. The first thing everybody looks at is a customer acquisition efficiency. For every dollar I invest in acquiring new customers and the associated ARR, how much ARR can I get back? And over time, how much customer lifetime value is that going to drive? And what's my enterprise value to revenue multiples? Next, beyond customer acquisition efficiency is what's my operating efficiency? Hey, what percentage of my total revenue is being consumed by sales and marketing or being consumed by R&D or being consumed by G&A? And as a company evolves to each stage, that's going to change. And the last one, after acquisition efficiency, SaaS business model and any recurring revenue model is all about how efficiently do I retain customers? And that includes how much do I spend on retaining the customers and the associated ARR? And then how efficient am I at expanding those existing customers that I actually keep? So if you go, there's like 7 metrics that I have found that public investors and Wall Street analysts and private investors, both private equity and VC, are really looking at to help create that overarching view of what's your company worth? Typically, what's your company worth is measured by your enterprise value compared to your next 12 months of revenue and projecting it forward. So I'll just go around the horn real quick. We're going to talk about more of these. Growth rate. Growth rate still viewed, especially in private companies, the number one attribute correlated to the enterprise value to revenue multiple. In fact, using the concept of the rule of X from Bessemer Venture Partners, it's about 2.5 times more important than operating profitability. Your acquisition efficiency is measured by CAC ratio and CAC payback period. Very important. And then a key investor metric is how does the lifetime value of each of those customers that you acquire compare to the investment you made to acquire, the CLTV to CAC ratio. Then we'll go over to Rule of 40. Now, Rule of 40 you're going to see is a much higher correlation to enterprise value to revenue multiples today than it was 2 years ago when growth trumped everything, and we'll talk about that. And then you've got your gross revenue retention rate. Some people call it gross dollar retention rate, and your net revenue retention rate. We're going to go each one of these in more detail, but these are the 7 metrics that are highly correlated to enterprise value to revenue multiples, and that investors and operators alike should understand. But we'll get into more detail in just a minute on which ones are more appropriate for operators to inform their decisions and for investors to make enterprise value decisions. So let's move forward to the next slide. And what I wanted to do for the audience is, we've been tracking what is the correlation of some of these key metrics to the enterprise value to revenue multiples. Now I'm looking at enterprise value to next 12 months multiples for public companies. By the way, I use Meritech Capital, which is a great source for public SaaS and cloud company metrics. And what you see here from January 22 to right now, yesterday, what is the correlation of this particular metric to your enterprise value to revenue multiples? And R squared is called the coefficient of determination. It's on a 0 to 1 scale. It just says, how much does this metric impact the dependent variable of enterprise value to revenue? So what you see here is in the go-go days, growth, and that was revenue growth, GAAP revenue growth, was 0.51. So on a 0 to 1 scale, impact on enterprise value to revenue. You're seeing that right now, it's down to 0.11. I've never seen it this low. But now let's go to ARR growth. Now, ARR growth, even though ARR is not a GAAP metric, people do calculate implied ARR, which is your revenue growth in the last quarter times 4. And then I divide that by the previous 4 quarters. That's 0.21. So that's a pretty good R squared that says growth is still important. But now if you go to the next one, this is the Rule of 40. Now, this is the balance of growth rate plus your operating profitability. Companies that are public will use free cash flow margin. Some private companies will use EBITDA as a proxy for free cash flow margin. But what you'll notice back in January 22, the Rule of 40, which is that blend of growth and operating profitability, very low correlation to enterprise value to revenue multiples. You'll see how it kind of went up. Back in January of last year, we started getting more excited again about growth. But now, as of June, I think this was June 9th, that R squared for the Rule of 40 to enterprise value to revenue multiples, 0.32. So it's the most important metric today. Now, we're not going to have time to go into this detail right now, but just because Rule of 40 is most important, what you really have to understand is what's the balance of the Rule of 40. And what I'm going to tell you is growth rates above 25% with a free cash flow margin of 10 to 20% is the optimal combination. If you've got a 10% growth rate and a 30% free cash flow margin, you're not going to have a great valuation. So they're still overpaying for the growth component of the Rule of 40. Do we have a question there, Kirk, that I can take?
We do. One just came in. I was going to let you finish, but here I've got a question here from Sarah. She says, what are the top metrics that investors care about that operators often overlook?
Ooh, that's a great question. I would say CLTV to CAC is one very important one. But as you notice right here, the ones we're talking about, both investors and operators are looking at all the time. So I'm going to think about that a little more, but right now, the only one I can think of is CLTV to CAC.
Sounds good.
Net revenue retention. This measures a cohort of customers, what their ARR was for a previous period, typically a fiscal calendar year, versus the current period. It includes all upsell, cross-sell, churn, and downsells. You'll notice how big that was in January 22.42. Now, I only highlight that because companies like Datadog, Snowflake really bias that, but now we're at about 2.1. So you see where NRR is pretty comparable to your ARR growth rate. We can keep going. And the next two, and we can do both at one time, SaaS magic number and gross margin. Investors are not too concerned about that because they capture it in all these other metrics. So let's keep going in the interest of time. We just released our private company benchmarks. We did this in concert and partnership with Emergence Capital and 12 different SaaS platforms. And the first thing, and this is no surprise to anyone, it just puts it in black and white, growth rate of private SaaS companies continue to decrease, both at the median. Now you see it didn't decrease a lot in calendar year 24. It was only down by 1%. But look at that top quartile, at the 75th percentile. To be a top quartile performing company last year, you had to be growing 60%. This year, it's down to 50%. However, I always say never look at total population benchmarks. You want to look at any one of these metrics and the associated benchmarks by your company profile attributes that are most relevant to the metric itself. So if you go to the next slide, you're going to see this growth rate broken down by ARR from less than 1 million, 1 to 5. You can read on the x-axis what those are. And what you'll notice is, hey, if you're in that 20 to 50 million, the median growth rate about 15%. By the way, that is very comparable to the median growth rate of public SaaS companies. But here's the surprising and concerning thing. Those companies that have increased to that 50 to 100 million and greater than 100 million, and a population of this total is about 563. I think the 50 million to 100 million was almost 80 or 90 companies. The median's 10%. That is very concerning to me about those companies, that cohort of customers, because they're growing at such a low rate. That tells me that their investors, whether it's private equity or VCs, is going to be laser focused on operating profitability, getting you up to that EBITDA of 20% or 30%. And we're not going to show it here, but companies that are spending less on sales and marketing have a high correlation to companies that are growing slower. If you're able to invest 35% and above in sales and marketing, you're going to be growing a hell of a lot faster than if you've taken that down to 25% because you're trying to reach a certain operating profitability goal. Kirk, any questions before we move on?
None yet. Super engaging. We'll push those through as they come up there. But I remember you presenting this and something, giving us a little sneak peek in New York at your recent event that you threw, which was absolutely phenomenal. And the R squared piece still just encapsulates me that somehow growth could be more important than profitability when it comes to your EV. Just blows my mind. And I'm sure the rest of us are having a similar sort of shock reaction to that.
Yeah. And I would encourage everyone, just do a search. I don't say Google search anymore. Maybe you do a Chat GPT search on the rule of X by Bessemer Venture Partners. And they show you the data that shows that the enterprise value to revenue multiples have the revenue is growth rate is 2.5 times more important than the operating profitability. So that says everything. Now, rule of 40 here for private companies, once you're $15 to $20 million, investors will want you to start tracking your rule of 40. Under 10 million, it's really not that important because growth is the most important. In fact, Byron Dieter from Bessemer Ventures, who has over 200 B2B SaaS exits, he did a session at SaaS Metrics Palooza last year, and it was all about, hey, we do start looking at rule 40, but we don't start looking at it until 15 to 20 million in ARR. And what this shows you with the rule of 40 going down from 20% to 15% is two things. Growth rates are decreasing and operating profitability actually decreased last year in private SaaS companies. And one of the reasons was they were investing a little bit more in growth with new customers and they just weren't achieving it. And you're going to see that in a couple more metrics going forward. So let's move
So
on.
one question here, Ray, before we do. Got a question. What percentile benchmark level should we aim for? My first reaction is 100, but any questions there as you're growing?
Don't be a slave to any particular metric, but you need to be targeting to be at median or above for all your metrics. So median is key. Now, your investors, and based upon your stage of company, they may have a higher focus on growth versus operating profitability, or they want you to be more efficient with acquiring new customers. So be aligned with your investors and what they're important, but you should be targeting everything at 50%. And if you're below 50 percentile, you should have the rationale. I'll give you an example. If your growth rate is in the top decile, so you're 90 percentile or above, but your CAC payback period is at 28th percentile, some investors will be okay with that because you're growing so much faster than your the company cohort. However, they're going to ask you to become more efficient, but they're going to be open to some of those trade-offs where growth is in the top quartile or top decile.
Gotcha.
Okay. Net revenue retention rates. Now you're going to say, well, this data is not changing that much. 101% at median. Anything above 100 is acceptable. But what I will tell you is in CY21, this was 105%. And the public company cohort, current median is 110%. So to see 101% NRR at median is once again concerning to me. And it's saying that even expansion ARR is becoming more difficult in concert with retention. Now, we're going to talk in a couple of minutes of how expansion ARR is now 40% of your total new growth, where it used to be 35%, and 2 years ago it was 25%. So this is a scary trend to me because it says I can only count on 1% of my growth coming from my existing customers, which is putting more pressure on new customer acquisition, which we're going to show you in a minute is much less efficient today than it was 12 or 24 months ago. I see a question there about logo retention. If you're a low ACV product, 5K and under, especially 1K and under, they are going to be more focused on logo retention. If you're in the definitely 25,000 and above, it's going to be all about gross revenue retention and net revenue retention. And logo is going to be much less important to an investor. A lot of people like to publish benchmarks or review benchmarks by company size, ARR. For retention metrics, both gross revenue and net revenue too, the highest correlation is to your ACV, not to your ARR. So that's why I'm showing this here. And you can see as the ACV goes up, for the most part, you'll see your NRR going up. Our 100K to 250K ACV cohort, I think there was some selection bias there. I had one of the companies, and there were only about, I think, less than 20 companies in that cohort. They were like at 94%. So they really brought the median down. But you typically, if you're in a 50K and above, you should be targeting 105% and above for your NRR. But
Beautiful.
always view benchmarks for retention by ACV.
Definitely. And I love these breakouts as well. One other thing here, I saw a question from Blake there. I think we've just responded to you, but yes, we will definitely be able to circulate these slides afterwards. I have certainly been paying a lot of attention to that R squared slide, so we'll be sharing those with you guys here. Moving on here, Ray, to gross revenue retention trend.
Yeah. I almost thought about not showing this. Most investors will look at gross revenue retention because they just want to see the contrast between gross revenue and net revenue. But at the end of the day, hey, if you're within a few percentage points of the median, they're not going to say a damn thing. They're more concerned about how fast am I growing and what's my net revenue retention. And as you see, gross revenue retention at median was only down 1 point. at the top quartile, 75th percentile, it was level, and our lowest quartile actually came up. So believe it or not, as measured by these 563 private SaaS companies that participate in this research, we're doing okay on GRR. Just not so good on NRR, which means growth is what's being challenged, which the growth rates and NRR show that. Once again, kind of show this by ACV. We have that little bit of selection bias anomaly in the 100K to 250K, but look at that 250K. It's 95%. And I just got off a podcast with the CFO of OneStream, and OneStream is a cloud platform for the finance, does a lot of FP&A type work. So some overlap to what Drivetrain does, but they do it across every industry and a lot of kind of $1 billion and above companies. Their gross revenue retention is 98%, 98%. And they have a ACV at $340,000. So here's a recent public company that went public, basically mimicking this private company benchmark. Okay, Kirk, let's move on.
This one, I think.
Good.
I was just saying, this one I think will have a lot of interest here. I personally have my own questions for you on this one, but I'll let you present first.
Okay. So this is my number one operator metric. And when I say operator, maybe I should say go-to-market operator along with the CFO. And what this does is it measures your total amount of fully loaded, fully burdened sales and marketing expenses divided by new ARR. So it basically says, hey, how much in sales and marketing do I spend to get $1 of new ARR? New ARR being defined as new name customer ARR plus existing customer expansion ARR. So what this says is, hey, this is pretty good news. Last year, we spent 19 cents less, which is, I think, 14% lower on blended CAC ratio. So I spent $1.40 in sales and marketing to get $1 of new plus expansion ARR. That's pretty good. And if I look at this metric in isolation, Kirk, I'm like, hey, we are more efficient. But whoa. What you're going to see as we go forward is the reason we're more efficient is because the mix of expansion to new name ARR dramatically changed. So it's not that I'm getting overall more efficient with my new customer spend. It's that I'm driving more revenue from existing customer expansion. We're going to talk about that in a minute. So
interesting. Now, I do see a question here from Gresham. Is the blended CAC ratio the same as cost to book?
I don't know. I've never used or saw anyone use cost to book. The key here, though, is it's ARR. So you don't do this on total contract value. So if a booking is 3 years, right, you're not really looking at blended CAC ratio for that total contract value. You're looking at it for the annual recurring revenue that's part of that agreement. When I say annual, not 3 times annual. If it's a $300,000 agreement for 3 years, that's 100,000 ARR.
Right.
Did I answer the question?
It looks like it did. We got a response. Gotcha. Thanks. From me, Ray, I have a question personally. We see at Drivetrain a lot of people doing the traditional sort of sales and marketing over new customers to get to CAC. Not so much CAC ratio, but CAC. I also see customers doing sales and marketing from 3 months ago, 5 months ago, because they have, a 90-day, 150-day pipeline. Is there one way you lean towards in terms of doing these ratios? And do you think that sort of change in calculation by offsetting it by a time series would change the metric here? Can I still ballpark myself in the same area if I do my CAC a little bit differently?
You can, but let's go to your first question, which is a lot of companies will take total sales and marketing divided by the number of new customers and get your customer acquisition costs. So if someone tells me, hey, Ray, my customer acquisition cost is $25,000, I'm like, so what? That tells us how efficient we are. I go, no, because if you're a $100,000 product, that's a great CAC. But if you're a $1,000 product, that's a terrible CAC. So that's why if you want to look at efficiency, I'm always looking at the value of the inputs versus the value of the output. So that's why CAC is nice, but CAC is just a first step to getting blended CAC ratio. Now,
Right.
on the sales cycle time, and the SaaS Metric Standards Board actually has this defined. If you're a 60 to 120 day sales cycle, we recommend using the same period for both the new ARR and the sales and marketing expense. Now, some people say, well, I could debate you and say, if I'm a 90-day sales cycle, all the cost went into the previous quarter. And the first question I will say is, what percentage of the deals closed in the last month of the quarter? What percent of the sales investment, which is 2/3 if you go to marketing investment, typically happen in the last quarter versus the preceding quarter? Purists could say use the preceding quarter of sales and marketing if your sales cycle is greater than 90 days. I say don't do that unless your sales cycle is greater than 150 days.
Got it. One
So
other question here, Ray, a bit more on the presentation side here. What are common mistakes companies make in reporting these metrics to investors? Right? In other words, I guess, would you leave things out? Would you show it in one way versus not another? Any mistakes you typically see there?
the number one issue with any of these metrics is clear definition of how they're being calculated and the
Mm,
consistency of that calculation over time, and that the investors and board know exactly what that definition is. So that's the most important thing. Um,
phenomenal.
the other thing I would say that's really important, excuse me, is when we get to new CAC ratio or expansion CAC ratio, best in class companies will allocate their sales and marketing investments between new name customer acquisition and existing customer expansion. Most companies say that's too hard because I have shared resources. And what our clients do is they just do a quick survey of all the people who touch new customer acquisition and existing customer expansion. Say, hey, what percentage of your time, right, do you think you spend on new customer acquisition versus existing? And
Mm,
those allocations are good enough to at least understand. And the reason that's so important, Kirk, is the next slide. If we can go to that. Why don't we go to the next one? In kind of an interest
sure.
of time. And that is, you want to know how efficient you are at acquiring new customers versus expanding existing customers. And what this says, and I highlighted this a little bit earlier, is we're becoming less efficient at acquiring new customers and the associated ARR. We're now spending $2 of sales and marketing to get $1 of new ARR. And that's actually up, what is that, 14% year over year? So if we believe that new customer acquisition is key to our growth and I'm spending 14% more, the old playbook's just not working. Now, we're not showing this here today, but expansion CAC ratio and why it's important to try to measure how much sales marketing and CS investments going towards the pursuit of upsells and cross sells. It used to be 61 to 69 cents. So we were investing 61 to 69 cents of sales marketing and CS to go get upsells and cross sells. We're now at $1. We're 42% higher in the last 12 to 18 months and expanding existing customer ARR. And as you're seeing, we're counting more on that for growth because 40% of our total ARR growth is coming from existing customers versus new name customers. So this is a common mistake and a real opportunity for best-in-class companies to say, how do I get more efficient at driving expansion ARR? And this shows the new CAC ratio. Once again, you'll see how it primarily goes up as ACV goes up. What was really interesting here, and we've seen this for 2 years in a row, companies that were selling greater than $100,000 ACV products, and that's annual contract value, so ARR, not just total contract value, they're actually more efficient. So if I'm selling a $75,000, $80,000 product, I'm actually thinking about what type of headroom do I have to increase my pricing for new customers? Can I do a little bit better job on value-based selling? And can I increase the ACV? And the reason that's so important is increase average contract value per new deal decreases your CAC ratio, decreases your CAC payback period, and increases, your operating profitability. And I'm looking at my clock here. We're 30 minutes into it, Kirk, so I think we're doing okay.
I think we're doing good. The cadence is good. The questions are flowing in. Definitely keep sending those questions in, guys. We got Ray for 30 more minutes, so let's use them.
Now, CAC payback period. Now, this is a great, simple investor metric. They're looking at what's the efficiency of my sales and marketing compared to my ARR on a gross margin adjusted basis. The reason it's more of an investor metric is you've got too many variables that go into that. It's gross margin adjusted. Excuse me. It doesn't tell me how efficient I am at really acquiring new and existing customers, because CAC payback period should be specific to new customer acquisition. By the way, never compare your CAC payback period as a private SaaS company to public, because public SaaS companies do not report or define CAC payback period the same way. They basically look at quarter over quarter revenue growth divided by sales and marketing from the previous quarter, but they gross margin adjust that revenue growth. So it's more like SaaS magic number. So it's not a very good operator metric because you don't know exactly what's causing your CAC payback period to be higher. In fact, if you look at CAC payback period for public companies right now, the median is 34 months, where private companies, it's 18 months. Let's move on. Okay, we're going to get into, now, I was an operator for almost 30 years of recurring revenue software companies. So a lot of this comes from my own operating experience and the work that I do with about 20 to 25 SaaS companies a year, looking at their SaaS metrics and how they compare to the benchmarks. So ARR growth rate, of course, it's all about how much new ARR I bring in, but upsell and cross-sell ARR is not being treated like new customer ARR. So think about, have you defined your upsell and cross-sell process? Do you have the same measurements for that expansion funnel as you do for new? Do I know what my drop-off rate? Do I know what my core and best performing ICP is for upsells and cross-sells? And do I have marketing and sales resources targeted that highest potential ICP? Of course, reducing your churn and downsells, but win rate. Just think about this. If I increase my win rate by 5%, or I increase my ACV, which is always what I used to do. I'd always go in and I'd try to find, how do I introduce value-based selling, increase my ACV by 20%, and I'm dramatically going to increase the new ARR and our ARR growth rate. So if you're a CFO on this call or an FP&A analyst, I'd be working very closely with my sales and sales development team to say, hey, what can we do to goose that win rate or increase our ACV by 10%? Any questions on that, Kirk?
Nothing coming in so far. Some good conversation in the background of the things we've previously spoken about here, but nothing in particular on this. But as they come through, I'll definitely raise them to you.
Okay. Can you just go back to the Rule of 40 real quick?
Sure.
Because Rule of 40 has both revenue and the cost side. A lot of the revenue components are the same. Looking at your OpEx as a percent of revenue, right? Because if you're looking at how do you spend most of your money, you're spending 35% on sales and marketing, 20 to 30% on R&D, and 15 to 20% on your G&A. Really look at, hey, how can I get that down? How can I increase the productivity of my employees? So when I have a attrition, maybe I don't hire a new one. And by the way, I hate to say it, AI is going to be a secret weapon to reducing OpEx as a percent of revenue. The best in class companies I'm talking to, and in fact, I just saw Jamie Dimon talking to PepsiCo, and that's a different industry, but they're looking at whenever I lose an employee, the first question we ask is, do I need to replace them, or how can I use AI to replace that headcount? And then, of course, gross profit and COGS is another opportunity. If you've introduced AI into your SaaS product, make sure you can break out the revenue versus the cost of goods sold for that AI product, because it can be highly variable today, especially if you're using third-party LLMs, and there can be a big opportunity there. Okay, let's move on. Blended CAC ratio. One of the things that you can do is change the mix. Hey, if you can get 10% more from your existing customers and you do it at half the cost, what a great way to reduce your blended CAC ratio. Everything else is pretty much the same. I'll go beyond win rate here. You want to look at opportunity funnel conversion from top of funnel. And even though I don't suggest we use MQLs, people start using MQLs. Marketing can have a big impact on this. To stop spending money on lower converting top of funnel opportunities and double, triple down into that ICP in marketing channels that's driving the highest conversion from engagement to a qualified lead to new ARR. Same thing with new
Phenomenal.
CAC ratio. Really look at that. Number one, look at your funnel conversion. Here's something else. We're finding native AI companies are on at median driving almost 50 to 75% more quota output than legacy SaaS. So if you're at a $800,000 of quota and a 50% achievement rate, hey, can I start using some of the new AI tools, change a little bit about my customer acquisition motion, and can I increase quota rates? Huge
How
opportunity
interesting.
to decrease new CAC ratio. Let's keep going.
Got one question for you here right before we go on. Victor Chan, I think we're going to address this a little bit later, but maybe you want to touch on it now. What stage of company do you see Rule of 40 as a key metric for? Since the metric spirit is to balance growth versus profitability, is there a similar metric investors use to evaluate earlier stage companies, for example, A, B, or C series?
So 15 to 20 million is typically when SaaS investors will start saying, let's look at least upon how your profitability trends are trending. Did you go from a negative 30% EBITDA to a negative 22%? They're not going to force you to get to positive operating profitability. They just want to see that you're getting more efficient as you grow. The burn rate is being used by a lot of early stage SaaS investors to say, hey, for how's my net burn compared to my net new ARR growth. So that's one. And I call it the cash conversion score, but you can also just call it ARR to capital raised. Hey, for the capital raised, how much ARR have I generated? When you're younger, you probably have 2 to 3x more capital raised than your ARR. But as you get towards 50 million, they're going to want to see that ARR to capital raise be on a 1-to-1 or a decimal basis. So if you're at 50 million ARR, hopefully you did that with 50 million or less capital raise. But if you're 100 million ARR, unless you're a top grower, they're going to see that you did that with 50 million, 75 million, so that your capital raised is lower than the ARR. So
phenomenal.
Net
That's a good
burn
one.
rate or burn rate for lower, and then your ARR to capital raised or cash conversion score.
Beautiful. Thanks for that, Ray.
Okay, let's move to the last one. CAC payback period. The key here is it's very similar to the CAC ratio with how you move it. The difference is it has gross margin, and this is primarily an investor metric. And if you're less than $10 million ARR, and you have an investor asking you about either CAC payback period or CLTV to CAC, I would try to steer them to be very focused on how efficient you are of acquiring dollars of new ARR or expansion ARR and away from the CLTV to CAC or the CAC payback period.
One more for you here, Ray. Oh, sorry.
Yeah. The only thing I'd say about NRR and ARR, NRR, it should be an operator and investor metric, but we had this conversation as we were prepping for today. If you are talking to your customer success leader or a CSM, right, some of these key drivers, they really can control the product adoption right up front based upon the quality of the onboarding, the product usage, things like your daily active users over monthly active users. NRR is going to be looking at the efficiency and efficacy of cross-sell and upsell. So one of the things you're always going to want to think, and Kirk, I think you're going to talk about this a little bit later, is there are frontline operator metrics versus executive operator metrics versus investor metrics. And NRR is going to be good for your CSM to know about, but your CSM really needs to understand, how do I drive retention and expansion? What are those tactical metrics? Okay, let's move forward. let's move forward. I think we've talked about these quite a bit.
No problem. So I think this is what you were talking about just briefly there at the end, Ray. Just for everybody in the audience, so I can explain this slide. This on the right is not the formula for what you see there on the left. Okay, this is actually a back calc formula that you might use for your operators. Let's explain this. On the left, this investor metric. This is what you traditionally see maybe for your investor. Growth rate, GRR margin, NRR percentage, rule of 40, these sorts of things. But what you might tell your operator is there in the middle column. You're not going to say to your sales rep, I need this % growth rate necessarily. You might instead, in the middle, give him an ARR target. Down the bottom there, you might not tell your sales and marketing team, this is going to be the CAC ratio we need at the end of the year, but you might instead say, here's the upper limit of your sales and marketing expense. So same idea, but different messaging, similar to what you were mentioning there, Ray. The formula you see there, that is the back calc formula for that middle piece, that middle item, the ARR target, the sales and marketing upper limit, these sorts of things there. So what we've actually done with this is created templates where you can plug in those sort of resulting metrics that you want, and it will do the back calculation for you. So the formulas you saw here, that will be actually in the template. We'll share these with you guys. You can probably see a link there right now. Take a look at these resources. We've got actually a lot of blogs that we post in, several times a week, a lot of templates out there that just help you back calc. Take them as kind of a guide, work them into your own models if you want. We can show you this in Drivetrain sometime or a little bit later today, depending on what you're interested in. But definitely look at how you can change that messaging, depending on if you're talking with an operator or an investor. Changes the formula slightly, but they're all the same function of each other. Now, one other thing here that I thought would be important to chime in on, Ray, and this is similar to Victor's question before, when do these metrics matter? And no one's better to talk to this than you. Could you tell me a little bit about what's happening on this slide? If you have any call outs, any big thoughts on this?
Yeah. The call out is the check marks are when you should begin thinking about instrumenting, tracking, and at least reviewing those metrics. And the plus is not only should you have them instrumented and be measuring them, they should be informing your decision. So I'll give you an example of that. Look at NRR, number 2, right? Hey, under $1 million, you're trying to get product market fit. You're trying to get some referable customers, right? And make sure that the dog hunts, so to speak. But as you get to 1 to 5 million, you're going to start looking at what is my retention rates, right? How many of those logos are being retained? What's my ARR retention rate as measured by GRR? And maybe I've got some upsells, or maybe my pricing has and packaging has, you go from tier 1 to tier 2, but you're just beginning to instrument and measure those. It's not until you're 5 million or bigger that you really should be using those to really inform some of your decisions and reporting them to your investors. Now, you may say, hey, Ray, I'm at 3 million and people want to know my NRR and my GRR. Yeah. So you might start at least tracking them, but are they really informing your decisions? Not nearly as much as when you get to 5 to 10 and 10 to 25. And I'll even look at things like sales and marketing as a % of revenue. If you look at the 4th from the bottom, hey, I'm saying make sure you know what they are. Hey, but when you're $1 million and you just hired your first VP of sales and they made $300,000 and you're doing 2 million, it's going to look out of whack, right? Because one person's taking a great %. But as you get more repeatability and you scale to that $5 and $10 million range, then sales and marketing as a % of revenue becomes a more important metric. So there's no black and white here, but this is just a framework that I've seen hundreds and hundreds of companies use to say, hey, when does this decision or this metric become more about informing decisions than interesting to know? Any questions on that, Kirk?
Nothing coming in so far on this. I'm assuming that everybody's going to want to take this away and take a look at it in their own time, and we will share these again. If for whatever reason you guys miss anything, just shoot us an email, and of course we'll share it with you. The next
Kirk,
one, though,
I will share the one thing, that cash runway, pretty damn important right up front, right? Especially if you're self-funded or bootstrapped. Yeah, you probably want to know what my cash runway is at all points in time.
Yeah, that should be front and center on that executive dashboard. There's no doubt about that. This one here, Ray,
Uh,
lagging leading indicators. I get a lot of questions on this. Obviously, you got a lot of insight here. What do you see as kind of like the main leading and lagging pieces?
everything we've talked about today are SaaS financial performance metrics that operators need to understand how efficient they're being with their capital spend up top and their investors. But then there's the head of sales or the head of marketing, right? To your point earlier, they may want to know what the CAC ratio is, but that's not what they're managing to every day, right? What they're managing to is I need this much pipeline to generate this much new ARR. I need to have a win rate of 20% to know that $1 million of pipeline is going to give me $200,000 of new ARR. So the ones at the bottom that are in the gray, those are often the input metrics and leading indicators that says, hey, I'm going to hit my CAC ratio goal, or I'm going to hit my NRR goal. So these are the things that your head of each of the GTM departments, quite frankly, maybe their directors or that next level down, they have those as measurable objectives and goals, and they understand how highly correlated or aligned they are to the company financial performance metrics being reported to the board. So I have a little bit different perspective on things like CAC ratio. Should your director of sales be held to that? No, but she should be aware of what that is and understands that if our quota performance across all our AEs is at 80% achievement, and I can have an average ACV of 25K and I have a 25% win rate, we're going to hit our CAC ratio. And if we're below it, we're not going to. So they don't measure to it, they don't manage to it, but they're aware of it. It's almost like, when we were giving all these stock options out, we never educated employees of what you're doing, how that impacts our stock price. So, hey, I've got 1,000 shares, but who cares, right? Oh, no. If everybody hits their quota and we generate 5 million, here's how that's going to impact our enterprise value, right? We owe it to our frontline and frontline managers to understand at least some of the mechanisms of what creates enterprise value for our company, even though we're not managing it to it at that level. Hopefully that helps.
Definitely helps me. Like probably a good example for most of the audience here. Now, this piece here, we promised that we'd talk a little bit about making the benchmarks actionable. How do we actually turn these into something that makes it, usable in our organization? I'll share this a little bit later with you guys. We can briefly touch on these, but just for the sake of time, I just want to go through these really quickly. Identify the metrics that matter for your business. Aligning on these is obviously really important, but getting buy-in from the wider group, that's a piece that can be a bit more difficult. This is what I think, what Ray talks about really well. Make it understandable for your investors. If they understand the math that's going into each of these metrics, it's a lot easier to get buy-in for that. Find the industry benchmarks for your key areas. Obviously, making sure that you're choosing the right benchmarks for you. You're not going to choose a benchmark for your 50 million ARR companies when you're a 10 million ARR company. Establish your eternal baseline. What's the goal that we're trying to hit? What's our kind of hurdle rate that we're trying to get to with each of these? And then use those benchmarks to identify your opportunities. What are the threats to this? What are the opportunities here? How could we possibly get higher than we expected? But what are the threats that could make it lower than we expect? And then make a plan to track your response. Make this measurable, right? If we're not doing this every single month or every single quarter, every single year, there's not a lot of point because we don't even have a trend analysis there. So I'll share this with you all later, and you'll have access to it. We can go into a bit more detail on that. But
Hey, Kirk,
really
just
quick-
can
oh
you
yeah,
can
go
you
ahead.
just go back to that real quick? 30
Yeah,
seconds. On number one, you want to identify the metrics that matter for your business at every level. At the executive team level, CFO level, maybe it's NRR, maybe it's GRR, maybe it's, of course, growth rate. But then create a metrics framework that says, oh, what that means for my head of marketing, here's the metrics that have direct correlation to that. And then to the director level, if new ARR, say, hey, if you hit 90% of your plan, then that's going to allow us to hit our new ARR. So make sure they cascade down.
That's a great point. Phenomenal. Just quickly, I wanted to jump over to a bit more of a hands-on workshop here. Ray, can you see my screen right here if I switch over to this?
I can.
Okay, beautiful. So what I've done here is repurposed a lot of the incredible metrics that you have, and I've put it into this drivetrain dashboard. And so this is actually pulling from BenchmarkIt, right? You can see the actual for this particular company. When I break that out for any given month, I can actually see, okay, what's this benchmark for my particular industry? What's my variance to that benchmark? What's my plan? What am I trying to reach? And what's the variance there yet again? So I get this sort of overall view of not only where I'm at, where the rest of the industry is, where I want to be, and the variance between all of them, which is quite nice. So we took a look in this case, in this sort of demo view, of all of the various different metrics that we thought would be appropriate for a company of this size, right? ARR 20 to 50 million, and put each of these in. A lot of the times we're seeing people use gauge charts as sort of how close have I got to achieving this given my given time period right here. And then down here, you'll see a fair few of those. The CAC payback period we spoke about, blended CAC period. Down at the bottom here, I've created a full list of those SaaS metrics that we've gone over today. This is the sort of thing that we see a lot of our, at least our SaaS-based customers using, right? This might not be applicable to some of our more inventory-heavy customers or operational customers, but for the SaaS ones in particular, we're seeing this be used a lot, and especially tying in the benchmarks, right? Especially working with you, Ray, that we've brought in. This has been quite valuable, and I've seen specifically a lot of the more executive levels jump in here as well. This may transition slightly into something like a P&L, right? Where obviously here the goal is to not only just see the data, but then be able to drill into the data. What can I do with this? Link back to my source system. Where is this coming from? How do I summarize all of these pieces? That's one thing that's key to call out about a system like this. When you see a number in Excel, right, I can't really do much with this, but when I click on this and show the underlying data, I have a lot more things I can work with. If I want to summarize this by a certain type or summarize this by a certain account, I should be able to do that, isolate for those unique values, and then get to it. So I think the main piece here is I just want to be able to take everything that we've learned today and make it trackable and easy to bring in those actuals, compare it against my budget, and then make it interactive where people can come in and isolate for maybe this bit of the pie chart and show the underlying data. Perhaps they even just want to, at this level, show the calculations for any given item, right? Depending on what we're looking at. And so this piece here, you're going to share it with your various teammates, whether that's internally or externally. Externally, I actually see a lot of the time people are scheduling the sending of these reports. They'll add their various different teammates and then they'll send it with some sort of recurrence, maybe Monday, Wednesday, Friday at like 6 a.m. or something, since all of our systems are syncing at 5 a.m. And so by the time 6 a.m. rolls around, all of us will now receive this Monday, Wednesday, Friday. So I'll pause here again. We can jump back to these slides here. We got another poll. And I'd love, given what you've seen here, if there's any interest in seeing a demo, I'd love to sit down with you and give you a little demo of the drivetrain platform. We're very intent on bringing in everything that Ray's spoken about today and making that actionable. And so whether it's your investors and you have one report for them and then one report for your operators, we're pretty committed to ensuring that these benchmarks can be outlined for you so that you can achieve those goals, keeping above that median, as Ray would say, in terms of keeping in line with those benchmarks. We also have a lot of useful templates, cheat sheets, and guides. These are all interlinkable. If you were me, you would click on them. But since you're you, I would say take a look at these slides later, and I will send these over to you guys, ensure that we share them. The only other piece I'll call out here is we've got a lot of educational assets, right? There's a lot of things coming up. We work with BenchmarkIt a lot, and we'd love to either have you join us or reach out to us. Keep these in mind, look them up, add them to your calendar. Ray, anything as these questions begin to come in that we've missed that are a must-have finisher for anybody listening today?
Well, we've got 5 minutes left, right?
Yeah, you bet. Anything you want to show?
Yeah. So I was looking at the Q&A, not the chat, and I may mispronounce. I don't know if it's Azam or Azam, but he asked some good questions. But one of it is, how do you use benchmarks in your company? So benchmarks are not absolutes. No single benchmark or no single metric should you be a slave to. But my recommendation is you should look at all your employees as stewards of the capital that you're investing to grow your company and create enterprise value. Yes, let your executive team know, hey, here's the benchmarks for companies like ours, just so they know. And of those, which are the metrics that you're really focusing on for the next 12 months? And how does that align to your strategy? So share them first with the executive team, but then there's nothing wrong with sharing benchmarks with the entire company and why they're important. So that's one thing I just wanted to add is benchmarks are guidelines, guardrails, not absolutes. but know what the trade-offs are between metric 1 and metric 2. And the other reason benchmarks are so important is when that new investor shows up at a board meeting saying your CAC payback period should be 12 and you're a 100K product and you're growing at 32% as a $30 million company, you can say, well, we're kind of using these benchmarks or our guidelines. So let's have a discussion about that. Because
Interesting.
sometimes even board members and investors, they're not thinking about your particular company. They're just thinking about the board meeting they left 2 days ago. And hey, that company had a 12-month CAC payback period. So why don't you have it?
Interesting. Got one more question here there for you, Ray. It said, we report CAC payback in months, but our CFO is pushing to shift it to a cohort-based view. Have you ever seen that before?
Yeah. And I saw another question earlier. I think it was about NRR and GRR. And we'll be careful how we define cohort. Often cohort is time-based. Some people use that as a word for segments, but the answer is yes. You should look at your CAC efficiency by customer segment. Your SMB should be separate from mid-market, should be separate from enterprise. So whether it's CAC payback period, CAC ratio, or NRR and GRR, you should always, as you get bigger and have multiple target ICPs or segments, measure all these metrics by that segment.
Okay, very good.
So the key there is cohort often will refer to time-based. So I want to know what my January of 2003 did compared to my January of 2004 new customers. So just be cognizant of cohort versus segment.
Yeah, fair enough. Great point. So no other questions here, Ray. Perhaps in the last 2 minutes, anything that you would recommend about turning what we've seen here today into something a little bit more actionable in the future? Anything you've got coming that people should be signing up for or thinking about?
I hate to say this because it's so trendy, but look deeply at your customer acquisition, retention, and expansion processes. And where do I have bottlenecks? Where do I have inefficiency? And where can I apply AI versus more people? Really important, because from what I'm seeing, if you're not fundamentally re-engineering some of your processes, you're going to be left in the dust over the next 2 to 3 years. So that's number one. And number two, I would just say, have a much more, develop a culture of numeracy, which means that everybody who's a director and above, their objectives are measurable, and that their measurable objectives are directly correlated and aligned to their managers' metrics and then your company's performance metrics.
Phenomenal. Everybody, I think that wraps up the call today. Ray, thanks again so much for joining us. We look forward to doing this again. Hopefully, we don't wait a year this time. For everybody that tuned in, once again, reach out to us. Enjoy the rest of your day.
It was a blast. Thank you, everyone.